Wow, what a day in the market. The market has been trading in the negative territories for most of the day until late in the afternoon. Federal Reserve Chairman Jerome Powell gave an update on the latest inflation and also interest rates outlook. The market responded immediately, shot way up, and finished the day with a big rally. So, what happened? What did he say? What does it mean to our economy, to the interest rates outlook, and the impact to our everyday life, our investment, our mortgage rates, etc.? Well, if you haven't got the time to watch the more than an hour of speech and Q&A session, and here's the highlights, and hopefully it will give you some idea. And in a bizarre twist, CNBC's Andrew Ross Sorkins, sitting at the Deal Book Summit in New York with live audience, did a live interview with SBF remotely from the Bahamas. And it's amazing that the extended interview lasts for, I think it's more than an hour, with many, many tough questions, straight questions. And it's amazing to watch how SBF responded, and I could not understand why he subject himself to a lot of liability. In any case, if you're interested in all these, I'm sure all the detail video replay is available on cnbc.com. So to help you in saving hours of your time trying to understand what's going on in the market, here's the highlights and the summary. According to Powell, inflation should be coming down in the coming months. However, inflation on housing prices will likely to continue well into the next year. In terms of the labor market, there are signs of moderation in terms of growth in labor and also wages. However, these signs are just tentative or temporary. So it's not yet showing a sustainable slowdown in the growth of wages and labor demand. So which means that it may still be driving the inflation upward. The shortfall in labor supply remain, and that gap, or the gap between the supply and demand in labor, is yet to be closed, and it will take time for that to happen. And also the wage growth remain above the normal level, which are consistent with the goal of 2% inflation, which means that the wage growth is still driving inflation higher. In a nutshell, he said, we're still a long way to go in terms of restoring pricing stability, which means inflation remains high, and we still have a lot of work to do in terms of controlling inflation and bringing it back down. And he signaled that the Federal Reserve game plan is to slow down the demand, the market demand, and slow down the economic growth. And that's the only way to fight inflation. And in order to do that, he expects an ongoing interest rates increase. In other words, we are not at the end of the rate increase cycle yet. And he also mentioned that this interest rate hike and quantitative tightening, the effect is yet to be felt, as it will take some time to work into the markets. In other words, we should expect further economic slowdown, if not recession, and also a higher unemployment rate. According to Powell, the QT policy seems to be working into the economy, and there's sign of slowing the inflation down. So it makes sense for a more moderate pace in terms of interest rates increase. And in fact, the lower interest rates increase may come as soon as December. As we can see here, well, the market has been expecting or forecasting most likely a 50 basis points of interest rates increase. Now, there is a chance that it may even lower than 50 basis points. As we can see here, the market responded and shot way up at that moment. On the other hand, he also emphasized that the interest rates has to rise to certain levels that's sufficiently enough to control this inflation. And it needs to stay at that level for some time in order for it to work in the economy. And he specifically mentioned that historically show that prematurely loosening up the policy, the tightening policy, will undo all the good work. In other words, the interest rate hike will continue and the Federal Reserve will stay the course of the QT cycle. While he indicated that the October inflation report, the CPI and the PPI, are pretty favorable, showing sign of inflation indeed is slowing down. However, history shows that inflation can creep back up if we stop what we're doing prematurely. In other words, the Fed will continue its course in terms of interest rate hike and quantitative tightening until the job is done, which means until inflation get back down to the target 2%. If you missed my video on the October updates on inflation, the CPI and PPI, please check back on those video for the detail. So based on the current Fed rates at 3.88% and the latest update by the Fed chair, the market is expecting the ultimate terminal Fed rates at 5%. In other words, we still have more than 1% of interest rates increase to go. And also, it will likely, the rates will stay up there for at least until 2024. As this happened, the Treasury notes yield starting to drop, the 2, 5, and 10 years all dropping very quickly, while the stock market rally all the way up. As we can see here, the Dow jumped by 1%, S&P almost 2%, and the Nasdaq more than 3%, and even the small cap Russell 2000 jumped by more than 2.5% to finish the day. However, I want to caution everyone that as every time when the Fed chairman speaks, it moved the market. We need to keep in mind that it's the action that the Fed they take in terms of rate hike, in terms of quantitative tightening, and that would have the real impact in the economy. Okay, so we need to separate the market if you're a trader, okay, or the economy if you're an investor. As investors, we should really pay attention to what this interest rate hike and the QT cycle will do to the economy, and in turn affecting the company's revenue and earning in order to make our decision on our investment. So hopefully this is helpful to everyone. If you need more detail, can always go back to the CNBC.com or the Bloomberg Financial News or Yahoo Financial to get all the details from what's happening during the day. So what does all these mean to us, and what should we expect and what should we do? Well, as typically any monetary or fiscal policy will take at least 9 months or even 12 to even 18 months to take full effect in the economy. In other words, the worst is yet to come in the next 12 to 18 months, whether it is a slower economic growth or slow economy, a mild recession or a severe recession, right? Depending on whether we can achieve the soft or hard landing. So we can expect in the next 12 to 18 months, we will see inflation may slowly come down, but it will continue to stay high. And interest rates will also stay high, which will directly impact, our credit card loan, our mortgage payment, etc. And we will see unemployment rates starting to rise. So there will be more layoffs. So I think we should prepare for that, right? And also as investor, we can see that we can expect, most of the corporate revenue and earning were starting to be compressed. So also price earning ratio, right? The multiple will come down as well. In other words, we can expect that bear market will likely continue. But again, as investor, we should also keep in mind that the market is always forward-looking, typically at least 6 to 12 months ahead. In other words, the market will bottom out before the economy will bottom up. Okay, so with that type of information, and we can continue to monitor what's going on in the economy and make our investing decision, whether it's short-term or long term. All right, I hope this information is helpful to everyone. So if you enjoy this, please like, subscribe, and don't forget the notification bell so that more people can enjoy this video and benefit from it. So thank you. Until next time, take care.